Hello, good evening, and a very warm welcome to our webinar on accounting for fixed assets. Thank you very much once again for your level of interest, for your liking our webinars. I have received innumerable emails um, and on how our members are finding these webinars of value and what do they think is the contribution that these webinars are making to their professional development. So I think our biggest reward of running these webinars is the kind of appreciation that you people share with us. At the same time, there are members who have made some very constructive suggestions, and for example, there was a member who suggested that we need to include disclosures in these webinars, and as a matter of fact, we have taken that suggestion very seriously, implemented it during our future webinars. But at the same time, since for certain webinars the number of disclosures is quite a lot, and in the interest of time, just because these webinars are very short duration and very to the point practical, so for some of the webinars we will be cutting short, talking about the disclosures aspect. However, in my conversation with the trainer, Mr. Abu Bakr, we have agreed that if there is a particular question related to disclosures that is not being discussed in the webinar, you can always direct those questions to him through email later on. That will help us save time. But at the same time, we will appreciate if you do not ask questions about disclosures during the webinar, as it can lead the discussion, to a tangent. Now, just some feedback for you, and how interesting or how useful members consider these webinars. I have, in the past 1 week, been to Lahore, Karachi, and Islamabad, and had an opportunity to meet various members at the new member ceremonies and at the Pakistan leadership conversations. I'm in 6 flagship events of ACCA that ACCA holds every year, and I can tell you that across board, there were so many members who wrote back, who came up to me and who showed their appreciation for the kind of value these webinars are adding. And once again, I'll reiterate, our consolation or our reward, in this entire effort, is the kind of feedback that you offer to us. And I'm sure our trainer would also agree that the biggest reward for the trainer is that if the participants are interactive and they're asking relevant questions, that's the biggest consolation, because that is real life, real time feedback coming that the attendees are taking this seriously, they're taking interest in it, and they're asking pertinent questions. But at the same time, if people give constructive feedback, they help us in improving the quality of the webinars. That's also very, very important. Yes. So I won't take too much of your time. I think this topic is of great interest once again. There are about 1,700 individuals from, I think, about 25 different countries who are attending this webinar, trying to listen to the content. So I will hand over very swiftly to our trainer, Mr. Abu Bakr. But once again, I reiterate, thank you very much for all your feedback. Thank you very much for all your interest. But please keep the feedback flowing. Please keep sending your feedback to us. Your certificates of the previous webinars have been disclosed, which have been shared. Your recording links have been shared with you of the previous webinars, and also the handouts that were shared with you during webinars. We have also given you links of those webinars to all the ones who have attended the previous webinars. We are now going to share it, share the recording and the handouts, the details of the handouts to those individuals who have not been able to attend it. So thank you very much once again. If there are any issues, if any concerns, any suggestions, you know my email address, members.pk@accaglobal.com. please keep sending your feedback to us. Thank you very much, and I'll very quickly hand over to Mr. Abu Bakr, who will take you through accounting for fixed assets. Thank you very much.
Thank you very much, Mr. Harun, and Assalamu alaikum, good evening, everybody. And as he mentioned that we will be incorporating disclosure wherever it is possible, but in some cases, if I give the example of International Financial Reporting Standard 7, that is the standard that is only meant for the disclosure. So sometimes that list is too long that we cannot discuss those disclosures in this short session. Anyway, if you have any question which is related to the standards, any of the standards, and that is not particularly related to the matter which is being discussed during this session, please feel free to send those questions on my email address, or you can route your question through ACCA as well. So I'll be happy to answer those questions to help our fraternity. This session will comprise 3 webinars, today, tomorrow, and day after tomorrow. And we shall be discussing various aspects of the fixed asset. And as we all know, fixed asset is covered by many standards, like International Accounting Standard 16, International Accounting Standard 20, to some extent International Accounting Standard 23, then impairment of those fixed assets, International Accounting Standard 36, intangible assets, International Accounting Standard 38, and investment property, International Accounting Standard 40. And then there is an interpretation 21 that is also related to the fixed asset, where decommissioning or restoration cost arise. We shall be discussing almost all these standards. So I'll be starting with some short standards, though a lot of material will be a revision, in fact. But there are points you will see, especially in International Accounting Standard 40, where you will find the change as compared to previous years, like as compared to previous 2-3 years, because there are certain changes as a result of updation in other standards, and the introduction of new standards like International Financial Reporting Standard 15, International Accounting Standard 16. So introduction of new standard and updation of other standard has got effect on like International Accounting Standard 40 and other standards. So we shall be starting with a very basic standard, borrowing cost. Borrowing cost, we shall be studying it in a practical way, in a practical manner. So as I used to say you at the start of each session, that please have a notebook and pen ready, and in case you need to make small calculations, just in order to refresh your knowledge. In fact, all these standards you people are studying from when you are a student. So though there will be practical aspects, but in fact this will be a revision of those basic concepts which we have learned right from the time when we were students. So you should have calculator with you so that you could just make small calculations to just refresh your knowledge of the borrowing cost. And of course, so once we finish with the International Accounting Standard 23, then we will go to another small standard, International Accounting Standard 20, which is government grants. And thereafter, we will start discussion of International Accounting Standard 40. So if that standard will not end today. If we could not finish that standard today, of course, that will continue. And we will continue our discussion tomorrow as well. So then we will move to the other standards as well. The objective of starting small standards is that last time I realized that because I pushed these small standards towards the end of that session, so sufficient time was not given to these small standards. And sometimes we really do not talk about these standards and feel that perhaps we understand these standards, but in fact, practically, I noted that people are making like mistakes in applying these basic standards as well. So that's why I took up these small standard right at the start of the session, and then we will be moving to the other standards tomorrow and day after tomorrow. So let's start with borrowing cost. So what is basically borrowing cost? What is the objective? The objective is, in fact, like if you are constructing a qualifying asset, if you are building a qualifying asset, so you may have to incur borrowing cost. So that borrowing cost will become the part of that qualifying asset. So now, what are the questions which will be addressed during this session? Number one, how can we define the borrowing cost? We will talk about it. Number two, how can we define the qualifying assets? And the most importantly, which assets which apparently fulfill the, or which are in fact qualifying asset, but we are not allowed by International Accounting Standard 23 to apply this standard. So we will be discussing this concept, and thereafter we will see how can we when borrowing cost will be capitalized, when we will suspend its capitalization, and when we will end the capitalization of the borrowing cost. Of course, we shall be considering all these aspects. Okay, borrowing cost may include interest expense calculated using the effective interest method under IFRS 9. So this is one. Finance charges in respect of lease liabilities recognized in accordance with IFRS 16. For example, in that construction, if you are using an asset, if you have an asset and you have the right of use of that asset, so on that right, there is a lease liability. The financial portion, financial charge of that lease liability will become the borrowing cost, and that will be included in that particular qualifying asset. And then the third one is exchange differences arising from foreign currency borrowings to the extent that they are regarded as an adjustment to interest costs. So borrowing costs in fact include these three. These are not borrowing costs. For example, you issue shares. When you issue share, there is a cost of equity. I mean, could be actual or imputed. So this is not borrowing cost because you are not borrowing in fact. Similarly, preference shares, preferred capital. If it is part of equity, then any dividend, imputed or actual, that will not be treated as borrowing cost. So this is one of the small point which we should keep in mind. Like these are not borrowing cost. Of course, obviously, like these are not borrowing. Equity is not borrowing. Anything which is related to the equity, that will not be treated as borrowing cost. Then this is the definition of qualifying asset. Qualifying asset Qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use. So very simple definition. Its examples could be when you manufacture plants, power generation facilities, investment property during the construction period, intangible assets during the development period, bearer plants, or made to order inventories. All these could be examples of qualifying assets. But remember, inventories that are manufactured or otherwise produced over a short period of time are not qualifying assets. Because if we look at the definition, it says like takes a substantial period of time. But if inventory is being manufactured over a short period of time, then that is not a qualifying asset. Obviously, that is not meeting the definition of the qualifying asset. Then assets that are ready for their intended use or sale. Like you buy a building which is ready for use or sale, so that is not a qualifying asset. In fact, qualifying asset is something which is being constructed by you people. Which is being constructed by you people. That's why I said investment property during the construction period, intangible asset during the construction period. And similarly, manufacturing plants which are in fact built. So these are the qualifying assets. Next is, this is again another point which I want you to remember. Some of the qualifying assets mean assets which fulfill the definition of the qualifying asset. You should not apply the requirements of the International Accounting Standard 23. Those are qualifying assets made at fair value, such as biological assets accounted for under International Accounting Standard 41, agriculture, and similarly inventories that are manufactured or otherwise produced in large quantities on a repetitive basis that take a substantial period to get ready for sale. See, that inventory is meeting the definition of the qualifying asset, but specifically it is required that you will not be applying International Accounting Standard 23. See, the example of such inventory is, for example, maturing whiskey. After distillation and premature dilution, the spirit is put in oak cask to mature. The maturation period can take a variable length of time. All Scotch whiskey must be aged for at least 3 years, although it is usually aged for a lot longer, anywhere between 8 to 30 years in common. And the longer the spirit has aged, the smoother the taste, but also the more costly the end product will be for the consumer to buy. So see, substantial period is involved, at least 3 years, and it could be from 8 years to 30 years. So maturing whiskey can take a substantial period of time, but you will not be applying International Accounting Standard 23. This means only made to order inventory which takes a substantial period of time. For example, you have been given an order to build a plant for your customer. Now this plant may take like 9 months, 1 year, 2 years. So you might have taken loan for the construction of this. This is inventory for you, though it is plant. This is the fixed asset for your customer, but for you, because you are constructing, you are building this plant for your customer. This is in fact your inventory. While building this inventory, if you have taken a loan, the interest expense of that loan will become the part of that. This means what we concluded, like if asset is being made at fair value, you will not be applying International Accounting Standard 23, and simply only 23 will apply to made to order inventories which fulfill that definition of the qualifying asset, mean which takes a substantial period of time to build. So, do we have any question? If you have any question, I can answer it now.
Abdul Rahman asked, Ravi Kumar asked, items purchased to be used in renovation, they can be qualifying asset even they still in the inventory?
Ravi, can you repeat your question? You bought some stores and spares, in fact. So can you repeat your question? Ravi, can you repeat your question?
He replied yes, but let him type.
Yeah, can we take another question, then we'll come to Ravi?
Yes, in between Mohammed in Fazil Pal, by the way, he has left. He said, what happens when a company changes its accounting policy of cost model to a revaluation model for property, plant, and equipment?
So, what happened mean? We are discussing International Accounting Standard 23, and we have just finished with the definition and examples of the qualifying asset. So it is better this question should be kept for International Accounting Standard 16.
Mohammed Shoaib Khalid asked, kindly define period of substantial period of time.
This is judgmental. I mean, you can safely say that something which is more than 6 months or around 1 year, but this is judgmental.
No.
Okay. So
we need to be a little louder.
Okay. So can you? Where is our mic? So we can make our mic nearer to me instead of.
I think
this is the mic. Okay. Okay. Next is again this is our borrowing cost principle. Like borrowing costs directly attributable to the acquisition, construction, or production of a qualifying asset are included in the cost of the asset. Other borrowing costs are recognized as an expense. Okay, let's come to the yes. Okay, Ravi. Yes.
Some other people are also asking questions.
Yes, please. Yes.
No answer asked. Our company had built a tripod, which took construction or development time of almost 2 years. Can its borrowing cost or interest cost of loan can be capitalized?
Yes, it can be capitalized. Yes, it can.
Okay, another person is asking a question, Usman Rahman. If an organization has a business of building houses and selling them, can we call them qualifying asset?
Yes, we can call them. If normally a house will take, I suppose, around 6 months or 7 months, so that can be taken as a qualifying asset.
Usman Yusuf again asking why inventories cannot get IAS 23 application.
Mr. Usman, because I suppose your question is for those inventories which take a substantial period of time, and that fulfills the definition of the qualifying asset. I suppose, Usman, your question is about those inventories. The reason is it is very difficult and complex, and this will not add much value to the user, because those are being manufactured on a repetitive basis and making calculations, okay, how much relates to which batch, when it finished, when it started. And doing standard settled got the comment something like this, that this will not add much value, but this will take a substantial amount of time of the management in the calculation of the interest expense related to that particular batch or things like this. This is the only reason.
Fahim is looking for some explanation over aging of price. Can it be used in IAS 23?
Sorry, again?
Aging of price.
Aging of price?
I think.
Aging of rice. Aging of rice, again, as I gave the example of maturing whiskey to make it more tasty. Similarly, cheese, it takes roughly 1.5 years, 18 months approximately. The same is the case with rice. These are inventories which takes a substantial period of time, and these are qualifying assets, but these are categorically these are not allowed under International Accounting Standard 23.
Sanal asked, if I will be receiving an order from Army to make uniforms, will interest charges on loan be accounted for as an capitalization expense?
See, in this case, like uniform will take very short period of time. Like for a person, a uniform will take very short period of time. We are not talking about the whole contract. Very short period of time. An inventory which can be built in a very short period of time, that is not a qualifying asset. So International Accounting Standard 23 will not apply to that.
Iqbal Sadruddin asking, when an organization draw a loan and only a portion of loan is used to build qualifying assets and the balance remain unutilized at year end, in that case, how much borrowing cost can be capitalized?
Iqbal, of course, in the coming slide, I hope this question will be answered. In case unanswered, please feel free to ask towards the end of International Accounting Standard 23. I suppose this will be answered.
Mariam asking, can you kindly further explain the second point relating to equity while discussing borrowing costs that are not included or capitalized?
Who is she?
Mariam.
Mariam, when we say borrowing cost, as it is obvious from the word borrowing, mean this cost is something which is related to your loans. So equity is not law. Like cost of, normally we calculate cost of equity, but that cost of equity is not a borrowing cost. We should not take it as a borrowing cost. And second, I think this should be very clear. Second is preference shares. Preference shares could be liability. They could be equity. If they are equity, then dividend related to those preference shares will not be treated as borrowing costs. But if those preference shares are liabilities, then dividend related to those preference shares will become the borrowing cost. If the money applied in the construction of a qualifying asset.
Adnan Lakhani asked, if the intention of holding and selling the inventories changes, can it be classified as capitalized asset?
Who is this?
Adnan Lakhani.
Adnan, very simple principle. Only made to order inventory, which takes a substantial period of time. Only those inventories are eligible, like borrowing cost can be capitalized in that case. Otherwise, no other inventory. Simple principle. Made to order inventory. If that will take a substantial time. Otherwise, any other inventory, simple principle, you will not capitalize the borrowing cost. I suppose, Adnan, it should be clear.
Maliha asked, if building house is someone's business, how can we consider it in this standard?
Madiha, as I answered this question earlier, building house mean this is the inventory of that like particular business. And if he is making those houses on the order of someone, like made to order, like there are contractors who like build houses on a special order. So there you can capitalize your borrowing cost.
Swan yourself, if application of any standard requirement is difficult or not cost efficient, can we ignore that standard requirement?
Only if the related transaction is immaterial, you can ignore that. Otherwise, no. If it is material, you will have to learn it. You will have to engage consultants, or you can discuss with your auditor, or at the end we are available here.
Hamid Akram, is the substantial time could be less than 1 year? If yes, it will not meet the definition of non-current asset, and the impact will be same if for less than 1 year a cost is capitalized or expensed out.
Who is this?
Hamid.
Hamid, when we say 1 year or less, it is not the life of the fixed asset. It is the duration which is required to build that asset. Hamid, I suppose you are clear. When we say substantial time, like around 1 year or a little less or a little more, we are not talking about the life of the asset which is being built. We are talking about the time which is required to build that asset. So that can be like 9 months, 10 months, and even then it can be a fixed asset if its life is more than 1 year.
Can you please give an example of point 3 under the heading borrowing cost?
Okay, let's go back to our exchange differences arising from foreign currency borrowings to the extent they are regarded as an adjustment to the to interest cost. For example, you have a loan in denominated in US dollars. Recently, what happened? You people know that rupee is depreciating significantly against the dollar, and when now you will be like you have to pay like say $100,000 as an interest. When you like entered into this transaction, when you obtained the loan, at that time dollar rupee exchange rate was something 110, and you have to pay like interest expense of like 100,000 each year. Now after this 1 year, you will be paying $100,000 and by using your rupees. But now because the rate is moved to 115 or 120, something like this, so this means you will be paying 5 rupees per dollar due to changes in the exchange rate. So that that will become the part of the borrowing cost. Okay, if I use Word document just to make it more clear, so I think that will be very helpful. Like your interest expense, is like say dollars, 100,000, and at the date of inception of loan, rate was 110 rupees against dollar. This was the rate. So this means your interest cost should be 100,000 multiplied by 110. So what should be your interest cost? That should be 100,000 into 110. So this will give us some figure. But now what happened after 1 year? Dollar rate moved to like 118, as it is happening these days. So now, in fact, you are paying 100,000 into 118. So what about 8 rupees? The concept is simple, that this 8 rupees is also your borrowing cost. Mean exchange differences. 8 rupees is an exchange difference arising from the foreign currency borrowings to the extent they are regarded as an adjustment to interest cost. So this 8 rupees is a change in the exchange rate, and as a result we need to pay more. We have to pay more money in order to settle our interest expense. So the whole amount will become your borrowing cost. You should not take it as if you will be using 110 for the calculation of the borrowing cost. The new rate will be applied to your figure in order to calculate the borrowing cost. That will automatically become the part of that cost. I hope it should be clear. If there is an increase in the interest expense as a result of change in exchange rate, so that is a borrowing cost. I hope it should be clear.
She said thank you.
You're welcome. Okay, let's move. Okay, do we have any
question?
Yes, please.
Skandar Kotwal asked, what if the loan is taken for the sake of qualifying assets, but the project gets delayed? How should it be treated?
This will be discussed very shortly.
Burhanuddin, the definition of borrowing costs also includes borrowing costs relating to the acquisition of a qualifying asset. So the substantial period in this situation is negligible. What does the acquisition mean?
No. Acquisition, if after that acquisition you need a substantial time to build it further to make it usable for you, only then this will become the qualifying asset. Otherwise, no. If you are acquiring an asset which is ready for use, as I mentioned, if you are using loan to acquire that asset, that will not be capitalized. The borrowing cost related to that loan will not be capitalized. Okay, let's move further.
Yes.
Okay. Okay, we were here, measurement. How can we measure borrowing cost? There are a few small principles. Like the first one is, where funds are borrowed, specifically borrowing cost eligible for capitalization are the actual cost incurred less any income earned on the temporary investment of such borrowings. So let's look at this principle with the help of this example. On 1st January 2014, ABC company borrowed $3 million to finance the production of 2 assets, both of which were expected to take a year to build. Work started during 2014. The loan facility was drawn down and incurred on 1st January 2014 and was utilized as follows, with the remaining funds invested temporarily. Asset A, Asset B, on 1st January 2014, 500,000, 1st July 2014, 500,000. Similarly, in case of Asset B, 1 million on 1st January 2014 and 1 million on 1st July 2014. The loan rate was 9% and ABC company can invest surplus funds at 7%. Calculate the borrowing cost, which may be capitalized for each of the asset, and consequently the cost of each asset as at 31st December 2014. So let's make it a poll question. Mr. Khayyam, can you write this thing that calculate the borrowing cost which may be capitalized for pool question, but the whole slide should be in front of that.
Which question do you want me to write?
Like this requirement. But before we pop up that question, they should be able to do some calculations. They should be able to do some calculations by looking at the data given on this slide.
I think we cannot.
So you people have 2-3 minutes. Just not for B. Just go for asset A.
Can we take this question after the break, because we need a couple of minutes to transfer it to the polls.
The whole scenario.
Yes.
Whole scenario can be shifted.
Yes.
Okay.
Is there a word limit on the
Yes.
question?
Yes.
Can we talk about that?
Can you write the question? If I
It'll have to be a
make
brief question.
Okay.
It'll have to be brief.
Okay. Asset only for asset A. Please calculate the borrowing cost only for asset A. And then the cost of asset A at 31st December 2014. Only I need this requirement.
We will do a poll question. And when you're doing this for asset A only.
Only because this is a very simple calculation.
Okay. We'll just take this. And do you want to give them options?
Yes, I can give them option.
Observe the last sentence and calculate the borrowing cost. Or type in the bold.
When a question is popped up, still they can see the slides or not?
Once the question is up, they only see the question. Slides go.
Okay, it is better by the time they
Yeah.
write a pop-up question, please note from this illustration only that for asset A, in fact, we borrowed 1 million for that. Total borrowing was 3 million, and as for asset A, this was 1 million, and for asset B, this was 2 million. And we want only you people to calculate for asset A. And note that for asset A, 1 million is a specific borrowing, and out of 1 million, 500,000 was utilized on 1st January 2014, and the remaining amount out of 1 million was utilized on 1st July 2014. Loan rate was 9%. Only you need this information, and ABC company can invest surplus funds at 7%. Even we can write 2 lines at least. Okay. Okay, I can narrate the options as well.
Just one second.
Okay.
What options do you want to?
Number 1. Number 1, 90,000, 9 tetra 0, 90,000. Option 2, 72,500. Option 3. Okay, 2 options are good.
Is there time to attempt? Is it over? Should we pop it up now?
Yes, we can pop it up. Please, everyone should participate in these short exercises, because this is our real appreciation. When you people participate, it gives us energy that you people are with us, and we are reaching you people. And this is the real benefit of this session, that we are refreshing what we learned maybe at the time of being student, or sometime we are focusing on a particular aspects of our practical life and we forget about some other things. So this give us the idea that you people are with us, and these are the productive session, in fact. Okay, pop up, please.
It's already there.
Okay.
How much time do you want to give them?
2 minutes.
Watch on the time.
Only 1 minute left, only 20% would you?
Only, okay, 1 minute left, and please come up. Please, response to this pop-up.
The 6% so far. %30% so far, and only 10 seconds left.
Okay.
Should we close now?
Okay, yes.
Close.
Yes.
45% people saying 90,000 and 55% people saying 72,500.
55% are correct. Unfortunately, for very basic standard, 45% are not correct. See, what we have seen the principle in this last slide. What should I do with this? Where funds are borrowed specifically. 1 million was borrowed specifically for asset A. And the whole amount was drawn down on 1st January 2014. See, 1 million was available with us on 1st January 2014. And what we did, we only utilized 500,000. And the remaining 500,000 we invested till 1st July when we needed it again. So this means, as per the principle, when funds are borrowed specifically, borrowing cost eligible for capitalization are the actual cost. So what is the actual cost? Here actual cost is 9% into 1 million, mean 90,000. Less, so this is very important. Actual cost incurred less any income. How much income? We know from the information that 500,000 was invested for 6 months. So this means that 500,000 earned income at the rate of 7% for 6 months. So that comes to 17,500. So this means 90,000 less 17,500. So this will give us 72,500. So this is the borrowing cost which shall be capitalized in this asset. I suppose the remaining 45% are very clear. If they have any ambiguity or they want me to explain it again, otherwise the principle is in front of you, very clear. Like when in practical situation you are borrowing a loan for specifically for an asset, the actual cost of that loan minus if you have temporarily invested any money out of that specific loan which is not being utilized for one or the other reason, because the whole money is not really required on the first day. You may need that money later on. So you invest that like surplus money or so that income will be deducted from your actual cost in order to calculate the borrowing cost which will be capitalized. Okay, let's the same principle will apply on the asset B. Asset B, you can see that we actually borrowed for this 2 million for asset B. Similarly, what we will do, we will simply apply 9% to the 2 million to calculate the actual cost of asset, the actual cost of borrowing for asset B. Now, this will give us 180,000. Now, here you can also see that 1 million was utilized on 1st January 2014, but we borrowed specifically for asset A 2 million. So this means 1 million was invested for 6 months till 1st July 2014. So this means this 1 million earned interest income at the rate of 7%. So that comes to 35,000. So actual cost 180,000 minus 35,000. This will give us borrowing cost to be capitalized. If I show you the working which I have done for you people, you can see over here. So this way you will be calculating, like in case of asset A, 90,000, and then this is the income which you have earned. So when you net of these two figures, this will give you 72,500. This means respected members who answered 72,500, they are corrected. Okay, now let's move to the next slide. This was the principle number 1. Now the next principle is where funds are part of a general pool. The eligible amount is determined by applying a capitalization rate to the expenditure on that asset. The capitalization rate will be the weighted average of the borrowing cost applicable to the general pool. However, borrowing cost included in this way must not exceed actual borrowing cost incurred. See, this is number 2, where if you are already having money in the company and you want to utilize that money for the qualifying asset, and that money is in fact coming from a pool of different loans. You obtain different loans at different point in time, and you have some money surplus from those loans, and now you want to build a qualifying asset by utilizing money from that particular pool. So the first step is, first of all, calculate the capitalization rate of that pool from where you have taken the money. Capitalization rate concept is very simple. Actual interest being paid divided by the outstanding period. So this will give you the capitalization rate. So first of all, you will be calculating the capitalization rate, and then you will be applying that capitalization rate to the money actually taken for the purpose of your qualifying asset. This will give you the borrowing cost, which will become part of that qualifying asset. Okay, let's see it with the help of an example. Like here is an example. You can see that company has 3 loans: bank loan 18%, bank loan 20%, bank loan 22%. Total is 12 million. The company year end is 31st December 2014. Bank loan of 20% was taken on April 30th, 2014. Other loans were brought forward from 2013. Capitalization rate is equal to borrowing cost incurred divided by borrowing outstanding. This is the formula for the calculation of the borrowing rate. The company year end is bank loan of 20% was taken on April 30th. So again, you can make a small calculation, and we are not going to make it a pop-up question because you need to look at this slide carefully in order to calculate the capitalization rate. Anyway, I want you people to just calculate this capitalization rate. Formula is there. Just apply that formula. See, there are 3 loans. I give you the hint. In the numerator, Borrowing cost incurred mean the interest amount you actually paid on these loans. No, see, bank loan 18% was outstanding for the whole year. Then bank loan at the rate of 20% was outstanding only for a part of the year, like from 30th April till 31st December. So when you calculate interest paid on this loan, you will be multiplying that amount with a time factor. And then bank loan 22% was again outstanding for the whole year. So simply apply this 22% to 3 million to calculate the like borrowing cost related to this. Then add all these three figures. This will give you the borrowing cost incurred divided by borrowing outstanding. Again, borrowings are there: 4 million, 5 million, 3 million. Only you need to take care about that particular loan which is outstanding only for a part of year. Like in this case, bank loan 20%. This is outstanding only for May, June, mean 8 months. So you will be multiplying its capital amount with 8 by 12.
So we can also create a question in the poll section if you want me to create.
No, this. Okay. Okay. Can you please answer this question? What is the capitalization rate? And mention it in your comment.
Few people are saying 17%, 20%. Salman Yusuf said 17%. Murtaza Balucha said 20%. Atif Bhatt said 17.06%. Mohammad Sohrab said 17.75%. Sukaina Fatma 17.05%. Capitalization rate is 17.06%. Muhammad Ali. Sarah Thomas 17%.
Can we use that slide?
Risky.
Very risky. Okay. Please, rest of the people should also try.
Burhanuddin Arif 17%, Talha Farooq 17%, Mari Iqbal 17.75%, Imran Raza Jafri 17.05%, Mohammad Asad Siddiqui 17.06%, Shehzad Khurram 17.05%, Anil Kumar 20%, Muhammad Imran 17.6%, Fahim Gilani 17%, capitalization rate by Ravi Kumar is 17.05%, Muhammad Adnan 17.8%.
Okay. So the answer is in fact 19.81% or 20%, you can say that 19.81%. So I try to, okay, let's see, it may work on like Word. No, it is not working. No, it is not working here. Okay. I think we should come back to our slide. So this is the solution, but in fact, I want to make you understand this is capitalization rate, just a very simple formula. No, actually, the way it is typed, that is restrictive if you want to explain the whole concept. In fact, in the numerator, when you calculated the borrowing cost, if you note that, this thing is very simple, like 4 million was the loan and this is the rate applicable to that loan. And what additional is there? This is the time factor. Mean the period during which this loan was outstanding. So this loan was outstanding for the whole year. So you multiplied it with 12 by 12 or 1, or even if you ignore it, I mean, your calculation will not affect. But in case of this loan, which you obtained on like 30th April, your time factor is 8 by 12. In fact, people who calculated, I suppose, 17%, they ignored this factor. And similarly, here again, this loan was outstanding for the whole year. So the numerator will become 2046666. So the people who made mistake only because of this time factor. Remember, principle is very simple. If you are obtaining a loan on 30th April, so you will have to pay interest from 30th April till the end of the year. But for the other loans which are outstanding right from the start of the year, so of course the time factor will be 12 by 12. The same principle will apply in the denominator. Simply, you will be multiplying the capital amount, principal amount with the time factor. Principal amount with the time factor. Principal amount with the time factor. And this will give you the outstanding borrowing. Just simply remember this. In the numerator, principal rate into time factor plus principal rate into time factor plus principal rate into time factor, and in the denominator, principal into time factor plus principal into time factor plus principal into time factor. So this is the way, this way you can calculate the capitalization rate. I hope I tried to make it as simple as possible. I hope it should be clear. So please answer with yes if you are clear with this concept.
Yes, lots of people say this.
Okay, thank you very much. So we can move further. Okay. Now, this is the illustration like which we can discuss. Here we shall be applying the principal B. What is the principal B? If you are building a qualifying asset from a general pool, so first you will calculate the capitalization rate. We learned how to calculate the capitalization rate, or for a lot of people who calculated it as 20%, for them we revised the method for the calculation of the capitalization rate. XYZ company had the following loans in place at the beginning and end of 2015. 1st January 2015, 31st December 2015, 10% bank loan B payable 2018, 240 million. This is the opening balance. Yes, 240 is again the closing balance. Mean this loan was outstanding for the whole year. We remember we need the time factor. 9.5% bank loan B payable 2019. 160 opening balance, 160 closing balance. This means this loan was also outstanding during the whole year. 8.9% debenture repayable 2017. No balance at the start of the period, and we obtained this loan somewhere in between the year. 8.9% debenture was issued to fund the construction of a qualifying asset, a piece of mining equipment, construction of which began on 1st July 2015. On 1st January 2015, XYZ company began construction of a qualifying asset, a piece of machinery for a hydroelectric plant using existing borrowings. Expenditure drawn down for the construction was 30 million on 1st January 2015, 20 million on 1st October 2015. Calculate the borrowing cost that can be capitalized for the hydroelectric plant machine. I want you, first of all, just calculate quickly, very quickly, capitalization rate. Capitalization rate. Please, you have 1 minute. During that, you can calculate capitalization rate. Once you calculate capitalization rate, put that figure in your comment. We will get the idea about that. We shall be having prayer break after 15 or 20 minutes. But I don't know if in any particular country the time is running out, because here in Pakistan we have plenty of time for saying this as a prayer, because Maghrib time is shifting day by day.
Artifact at 9.66%. $9.657% Shehzad Khurram.
How much?
9.66%.
9.
Mehboob Usmani 9.66%. Olencio 9.65%.
Lencio.
Abdul Rafi 9.64%. Ravi Kumar 11.06%. .7% by Ramya. Waqas Ilyas 9.67%. Zishan Aziz 13.7%. Mohammad Hamza 9.46%. Manisha Devi 9.65%.
Okay. You keep on mentioning it in the comment, but be attentive. Let's have a discussion on this. See, here there are 3 loans, but our question related to the hydroelectric plant machine. That hydroelectric plant machine was in fact being built from 2 loans, 10% bank loan and 9.5% bank loan repayable 2019. 8.9% is a specific loan that is not a part of the pool, general pool. And we have taken money from the hydroelectric plant machine from the general pool. So we should be careful in the calculation, because what we are doing, we are calculating the capitalization rate of the general pool. 8.9% debenture is not a part of that general pool. That is a specific loan that has taken to build another qualifying asset. So please exclude it from your calculation. So be careful, even in practically, if you have like 4 or 5 loans and any of them is taken for a specific qualifying asset, so that should be excluded from this calculation, because that is meant for a specific qualifying asset, and that was taken for that particular purpose. So that will not be treated as a part of that general pool. So that's why I would ask you to again calculate the capitalization rate for 10% bank loan repayable 2018 and 9.5% bank loan repayable 2019. I hope my point is clear. Similarly, practically, be careful with the help of this question. What we understood, like if we have more than 1 loan and we started building a qualifying asset, for the capitalization rate, we need to see if there is a specific loan for any specific purpose, could be for qualifying asset, that should not become part of that pool. If it is not a part of pool, so we cannot incorporate that in the calculation of the capitalization rate. So please recalculate it quickly, only considering first 2 loans.
Calculating it, and the answers are like 9.8% by Olencio.
Olencio, you are right. If I pronunciate your
9.8%.
okay.
and Adnan Lakhani 9.8%, Shamsul Alam 13%, Mari Iqbal 9.8%.
Shamsul Alam, what are you doing? See, simply, there is no time factor, in fact. Both loans are outstanding, so please recalculate it. I hope you will do it good.
Olentu said perfect pronunciation.
Olentu, thank you very much. From which country you belong to?
So Canada 9.8%,
Okay.
Islam 9.8%, India, Goa.
India, Goa. Welcome.
But residing in Qatar.
Okay. So we are neighbor, in fact. Okay. So 9.8% is the correct answer. So this was the capitalization rate. Now, simply for the other part of the point, so this is the capitalization rate, and we can look at the answer to just see the other aspect. So this was your capitalization rate, 0.8, 9.8%, 9.8%. So initially you utilized 30 million. So you multiplied this 30 million with 9.8%, and this will give you 2.94 borrowing cost, and then you utilized 20 million. Later on, I suppose, yes. So this will give you 0.49, and then the total borrowing cost which need to be capitalized is 3.43, in fact. Okay, let's move further. Okay, now the principle 3 is capitalization should commence when expenditures are being incurred, borrowing costs are being incurred, and the activities that are necessary to prepare the asset for its intended use or sale are in progress. May include some activities. See, for example, the activities include technical and administrative work prior to the commencement of the physical construction, such as the activities associated with obtaining permits prior to the commencement of the physical construction. So, I mean, that will also be taken as if asset has started. Like you can start capitalization of your borrowing cost. So this, all these three conditions should be there, like expenditures are being incurred, borrowing costs are being incurred, and activities necessary to prepare the asset. If these three conditions are there, you can start the capitalization of borrowing cost. Then the principle D is capitalization should be suspended during periods in which active development is interrupted. However, an entity does not normally suspend capitalization borrowing costs during a period when it carries out substantial technical administrative work. An entity also does not suspend capitalizing borrowing costs when a temporary delay is a necessary part of the process of getting an asset ready for its intended use or sale. For example, capitalization continues during the extended period that high water levels delay construction of a bridge. If such high water levels are common during the construction period in the geographical region involved. So this is principle number 4, I suppose. Capitalization should cease. The next is capitalization should cease when substantially all of the activities necessary to prepare the asset for its intended use or sale are complete. For example, there could be two types of asset. One is like business park comprising several buildings, each of which can be used individually, is an example of a qualifying asset for which each part is capable of capitalization should cease. Okay, its example should be capitalization should cease when substantially all of the activities necessary to prepare the asset. Okay, we are talking about this. For example, bridge is ready. Bridge is ready. Only some floral work or some decoration work is being done to make it ready for inauguration or things like this. But otherwise, substantially it is ready. Only minor work is being done. Then at that point, when it is substantially ready, you should stop the capitalization of the borrowing cost. Then if only minor modifications are outstanding, this indicates that substantially all of the activities are complete. This relates to point number E. Where construction is completed in stages. When I was talking about the business park involving several buildings, so that example in fact relates to G. Mean where construction is completed in stages which can be used while construction of the other part continues, capitalization of attributable borrowing costs should cease when substantially all of the activities necessary to prepare that part for its intended use or sale are complete. See, as I said earlier, you are building a business park comprising several buildings, each of which can be used individually, is an example of qualifying asset for which each part is capable of being usable while construction continues on other parts. An example of a qualifying asset that need to be complete before any part can be used is an industrial plant involving several processes which are carried out in sequence at different parts of the plant within the same site, such as a steel mill, like furnace, then rolling mill, and then other departments. So this is the principle G. Okay. Let's have a look at another illustration to cover some of the principle which we discussed in our last slide. Apex issued a $10 million unsecured loan with a coupon nominal interest of 6% on 1st April 2009. The loan is redeemable at a premium, which means that the loan has an effective finance cost of 7.5% per annum. The loan was specifically issued to finance the building of a new store, which meets the definition of a qualifying asset in International Accounting Standard 23. Construction of the store commenced on 1st May 2009 and it was completed and ready for use on 28th February 2010, but did not open for trading until 1st April 2010. During the year, trading at Apex other stores was below expectations, so Apex suspended the construction of the new store for a 2-month period during July and August 2009. The proceeds of the loan were temporarily invested for the month of April 2009 and earned interest of 40,000 required. Calculate the net borrowing cost that should be capitalized as part of the cost of the new store and the finance cost that should be reported in the income statement for the year ended 31st March 2010. Before you people try this illustration, I just would like to remind you that this is the rate which will be used, because if we just recall the definition of the borrowing cost may include, not definition, where I have given few examples, like borrowing cost may include effective interest rate. So this is the effective interest rate. This is irrelevant. In fact, this is irrelevant. You will be using the effective interest rate, or if effective interest rate is not given, you can use the market interest rate. But 6% will not be used, nominal interest rate. But both can be same. In that case, it does not make any difference. But if there is a difference between these two rates, of course, you will be using effective finance cost for the calculation of the borrowing cost. So please, by utilizing the principle, some of the principle which we have just discussed, so please calculate the borrowing cost, which should be capitalized. And then mention your answer in the comment.
in the meanwhile, can we take other questions? Abdul Basit is asking, sir, if management takes the loan in start of the year and uses 40% of the loan only for construction, the QA, remaining 60% it keeps in bank but does not invest anywhere. In that case, I believe nothing should be done for the 60% balance, if I'm right.
If there is no interest income, if it is zero, of course. But the first question is, like, if you need like 100 rupees, if you need 40 rupees, why you are taking out 60 rupees? If I suppose that as per the term of the loan, or you in fact need 100 but immediately you need 40, then if there is no interest income, of course you will, the whole amount, the actual cost of the 100 will become your borrowing cost. I suppose you people have done, because very simple calculation, 7.5% is the rate.
Shakil Zulfikar said 5,10,000.
Okay.
Lancio 5 lakh.
Mm-hmm.
Only two people answered.
No, please come up.
Nadia,
this is not difficult question. Simply 10 million loan, and I told you you will be applying 7.5%. You need to take care only the period of suspension. You need to decide based on the principle which we discussed in our earlier slide. Do you need to capitalize the borrowing cost related to that suspension period or not? And similarly, I suppose this was started late. Construction was started late. In fact, you draw down the loan 1 month earlier than the start of the construction of the disqualifying asset. Please come up.
Nadia Rahim said 5,60,000. Atif Bhatt 5,62,500. Fateh Fakhri 4,60,000.
Fateh, come up, please.
Saad Khan 6.25. I don't know.
Okay, just answer one thing. Tell me the number of months for the calculation of the borrowing cost which should be capitalized.
Profit and loss amount will be 1,25,000 and capitalization cost will be 5,85,000. Sarah Thomas, Zishan Tool 500,000 to be capitalized. Mehboob Usmani 7,10,000. Abdur Rafi 5 lakh. Zishan Aziz 4,60,000. Shiraz Adir Baksh 5,85,000. Mohammad Shoaib 5 lakh. Madiha Suhail 4,60,000. Zishan Tool 2,10,000 to be expected.
Okay, let me come to the answer. See here.
8 months people.
Okay, how many months? What?
8 months, Mohammad Wasif.
8 months, Mohammad Wasif. Your answer is correct. 8 months is basically the answer for those months of which borrowing cost will be capitalized. How we have calculated the 8 months? See, we have drawn down this loan on 1st April 2009, and for the whole April, construction was not started. So this 1 month is out. We are discussing about the whole year from 1st April 2009 till 31st March 2010. These are the 12 months. 1 month gone, and then the work was suspended during July and August for 2 months. 1 plus 2, 3 months, remaining 9 months, and then this was completed. On 1st May. To construction was ready for use on 28 Feb 2010. So again, we should cease our capitalization on 28 Feb 2010. March gone, this means total 8 months. See, you can see from here, construction was commenced on 1st May 2009. We are talking about the whole year, from 1st April 2009 till 31st December 2009. We are talking about this year. The loan was outstanding during this whole period. Now, construction was completed on 28th Feb. This means finance costs related to the March 2010 cannot be capitalized. Then the work was suspended for July and August 2009. This means finance costs related to these 2 months will not be capitalized. And then construction was commenced on 1st May. This means finance costs related to the April 2009 cannot be capitalized. We can only capitalize finance costs for the 8 months. So when we apply 7.5%, 7.5% to the total loan, which is 750,000, and then we will multiply it with the time factor of 8 by 12. This will give us 500,000. Those members who answered 500,000 are correct. Now the next question arises, which I suppose should be in the mind of most of the people who answered 460,000, is that why we are not deducting the investment income of 40,000 from 500,000 while calculating the net borrowing cost. The reason is, please note this principle: if you earn income during a period when borrowing cost is not being capitalized, then that income will not be deducted while calculating the borrowing cost. I hope this is very important concept, which I tried to make you understand with the help of this illustration. I hope it should be clear. I repeat some of the important concepts which we learned from this illustration. Number one, even if we have taken loan earlier, if construction is not commenced, or at least the activity necessary to start the physical construction has not started, you cannot capitalize finance costs related to that period. Once construction started, from that point onward, you can capitalize your finance costs. Again, about the suspension, we are very clear: 2 months of suspension, and we will cease our capitalization when the asset is ready for use, or substantially it is ready for use, and that is 28 Feb. Then the next important principle is, like, this 40,000 is earned, it is specifically mentioned, it is earned in April 2009. For finance costs related to April 2009 is not being capitalized. So if finance costs is not being capitalized, so if we have earned any income during that period, that will also will also not be deducted while calculating the borrowing cost. So this is the important principle which I want to highlight. I hope it is clear to everybody. We are, if you people have any questions,
clear.
okay. So we can take a short break for Asr prayer. So please say your prayer. So please mute it. Sure. Okay. Now, disclosures. These are the disclosures. Very simple disclosures, two disclosures about of this standard. Number one is amount of borrowing cost capitalized during the period. You need to disclose, number one, this. And the capitalization rate used to determine the amount of borrowing cost eligible for capitalization. What was the capitalization rate used to determine? So these are the two disclosures related to this standard. So this is all about International Accounting Standard 23. And now we move to our next standard, which is International Accounting Standard 20. Again, a small standard, but we shall revise and refresh our concepts related to this standard. This is also included in the fixed asset, reason being like this standard talks about like government grants related to the fixed asset, and there are some concepts which need to be revised related to especially government grant related to the fixed asset. Government grants. Accounting for government grant and disclosure of government grant. Okay. Scope of this standard is this standard does not deal with government assistance that is provided in the form of benefits in determining the taxable income. Means government assistance that is provided for an entity in the form of benefits that are available in determining the taxable profit or tax loss, or are determined or are limited on the basis of income tax liability. Examples of such benefits are income tax holidays, investment tax credits, accelerated depreciation allowances, and reduced income tax rates. All these are examples of, these are the benefits provided by, given by the government, but International Accounting Standard 20 will not apply to this type of transaction. So this is important. Then is government participation in the ownership of the entity. Like if government buys some share, so this should not be taken as if, or it should not be treated under International Accounting Standard 20. Then is government grants covered by International Accounting Standard 41 Agriculture, because that standard in fact includes the guidance about the treatment of the government grants related to the agriculture. Then it's like if government grants like some sort of help because of inflation or changing prices in the context of in general context. So that will also not fall under this International Accounting Standard 20. Okay. Next is there are some definitions. Government agencies, and similar bodies, be they local or national or international. Then government assistance, action by government designed to provide an economic benefit specific to an entity or range of entities qualifying under certain criteria. So this is the definition of government assistance. Government grants: assistance by government in the form of transfers of resources to an entity in return for past or future compliance with certain conditions relating to operating activities of the entity. They exclude those forms of government assistance which cannot reasonably have value placed upon them, and transaction with government which cannot be distinguished from the normal trading transactions of the entity. Examples of assistance that cannot reasonably have a value placed upon them are free technical or marketing advice and the provision of guarantees. Like you want to expand your business overseas, like you want to expand or you want to start a branch in like Dubai, and the government help you in providing information about the marketability, about the demand of your product based on whatever information government has from its foreign office. So this is an example of assistance that cannot, on which we cannot place any value reasonably, in fact. An example of assistance that cannot be distinguished from the normal trading transactions of the entity is a government procurement policy that is responsible for a portion of the entity sales. The existence of the benefit might be unquestioned, benefit is there, but any attempt to segregate the trading activities from government assistance could well be arbitrary. So that's why this is also not included over here. Grants related to assets, government grants whose primary condition is that an entity qualifying for them should purchase, construct, or otherwise acquire non-current assets. Subsidiary conditions may also be attached, restricting the type or location of the assets or the periods during which they are to be acquired or held. Similarly, grants related to income, government grants other than those related to assets, forgivable loans, like loans from the government, where the government undertakes to waive repayment under certain prescribed conditions. Even if government is providing loan at a below market interest rate, that is also treated as government grant. Fair value, this is the definition. We already know from many standards. Okay. In this standard, International Accounting Standard 20, government assistance does not include the provision of infrastructure by improvement to the general transport and communication network and the supply of improved facilities such as irrigation or water, like water or electricity, which is available on an ongoing basis for the benefit of the entire local community. Like here in Pakistan, some of our like provincial governments are working on the infrastructure, but that infrastructure will not be taken as government assistance. If government assistance is not there, this means that is not in fact government grant. This does not mean that development is not helpful. That is helpful, but in fact, as per the definition, that is not taken as government assistance because that is generally benefiting the local community. Okay. Then is recognition. Again, the principle is an entity should not. Okay, before moving to the principle, I would like to highlight another aspect with reference to SAC 10. So before we, okay. because we are discussing what is covered, what is not covered, what is government grant, what is not government grant. So this interpretation is relevant to that discussion. So that's why I'm going to discuss it at this point in time. In some countries, government assistance to entities may be aimed at encouragement or long-term support of business activities, either in certain regions or industry sectors. Conditions to receive such assistance may not specifically relate to the operating activities of the entity. Examples of such assistance are transfers of resources by government to entities which operate in a particular industry, continue operating in recently privatized industries, start or continue to run their business in underdeveloped areas. The issue is whether such government assistance is a government grant within the scope of IAS 20 and therefore should be accounted for in accordance with this standard. Government assistance to entities meets the definition of government grant in IAS 20 even if there are no conditions specifically relating to the operating activities of the entity other than the requirement to operate in a certain region or industry sector. Such grants should therefore not be credited directly to the equity. In other words, International Accounting Standard 20 will be applicable to this type of assistance. This will be treated as a government grant. If there is no other operational condition, please note that there is no other operational condition except government wants you to operate in a particular industry, for example, or for example, they want you to continue in a recently privatized industries or start or continue to run your business in underdeveloped areas. I mean, conditions are there, but you can see that these are not specifically related to your operating activities, generally related. So these will be treated as per this interpretation, this will be treated under International Accounting Standard 20. So if we have any question, I can answer now before moving to the recognition criteria. Yes, if people have any question, I can answer.
Any question in relation to IAS 23, do we take?
Yes, no problem.
Okay, Dishant, were asking, I wanted to know the answer for the finance cost for the last question that needs to be reported in income statement in respect of IAS 23. Last question.
Finance cost. Can you repeat this question? What is that?
He said, I want to know the answer for the finance cost in respect of last question of IAS 23 that needs to be reported in the income statement.
See, 700, I suppose 750,000. Okay, let's go back to that question so it will be easy to answer that. So where are the slides? Have you, where are those slides? Yeah, here. Okay. So, whatever. Okay, let's here. We are here. See, 750,000 was the total finance cost. And out of 750,000, 500,000 is capitalized. And now this is a part of the cost of the property, plant and equipment. The remaining 250,000 will be charged to the income statement because that is not eligible for capitalization. And similarly, the investment income is also credited to the profit and loss account. I hope it is clear. Please mention if it is clear. Any other question?
Mohammed Smart said, if we lock a deal with customer where ownership will be remaining with seller and it will be transferred to customer at the end of at the end of term, pre-decided at day one. How will we record this transaction in seller books?
In
Seller's books.
seller's books, what's the name of this?
Mohammed Usman.
Mohammed Usman, I'm afraid your question is not related to International Accounting Standard 23. You are, I suppose you are asking something related to the lease or when you sale and lease back. So it is bad. If I'm wrong, so please clarify your question. If it is really related to the lease, so please send me an email, no problem. I will be answering your specific question. But right now we are taking question only related to the material which is being discussed. Okay.
Mariam Alauddin, can you kindly provide an example of transaction with government which cannot be distinguished from normal transactions of entity under the heading of definitions?
Yes, like you are a tire manufacturer, motor vehicles tire manufacturer, like Bridgestone, and Pakistan Army wants to buy tires from your company. So, this is a transaction with the government, and any sale transaction is beneficial for you. But this transaction cannot be distinguished from normal course of business. Mariam, I hope it is clear. Next.
No more questions.
Okay. Okay. Now comes to the International Accounting Standard 20. Okay. We discussed this interpretation. Recognition. An entity should not recognize government grants, including non-monetary grants at fair value, until it has reasonable assurance that the entity will comply with any conditions attached to the grant. The entity will actually receive the grant. So both conditions should be there. Even if you have received the money, that is not important. In fact, you should comply with all the conditions. So this means these two conditions must be there. Like it makes no difference in the treatment of the grant, whether it is received in cash or given as a reduction in a liability to the government. That is, the manner of receipt is irrelevant. Any related contingencies should be recognized under International Accounting Standard 37, provisions, contingent liabilities, and contingent assets, once the grant has been recognized. In case of forgivable loans, it should be treated in the same way as government grant when it is reasonably assured that the entity will meet the relevant terms for the forgiveness. In addition to forgiveness, if government has given you a loan at a rate below the market rate, this is also a benefit. This is also a government grant. So this will be recognized as a government grant. Accounting treatment of government grant. International Accounting Standard 20 government grants requires that the government grant should be recognized as income over the relevant periods to match them with related cost which they have been received to compensate. This should be done on a systematic basis. Grants should not therefore be credited directly to the equity. Where grants are received in relation to depreciating asset, this is again very relevant point because we are focusing on this point. The grant will be recognized over the periods in which the asset is depreciated and in the same proportions. Example, we have an example here. Simple example, like XYZ company receives a government grant representing 50% of the cost of a depreciating asset, which cost 40,000. How will the grant be recognized if XYZ company depreciate the asset over 4 years straight line? or at 40% reducing balance. Can we make it pop-up question? Do we have enough space for these 2 or 3 lines?
I think we can make a question.
Only for the first year. Just tell about the first year. Like, how will the grant be recognized?
Do you want them to calculate residual value?
No, only for the first year, the amount of the grant which will be recognized in first year. The amount of the grant which will be recognized at the end of first year, only at the end of first year.
So, what should we offer them in answers?
Okay. In answer, for A, straight line method, only for straight line method, no problem. We can make another pop-up question for the reducing balance. For first year, the amount of the grant to be recognized for the first year in the income statement. In case of straight line method, there are 2 options. A option, 10,000. B option, 5,000. So
I'm going to revise this. Sorry.
please participate in this pop-up question.
How much time should be allocated?
1 minute is enough.
So far, 12% voted. support.
Please. Very simple question. Answer it so that we can assure ourselves that we understand International Accounting Standard 20 very well, because this is the normal impression for this standard. Easy standard, but there are certain things which need to be refreshed.
So far, 21%. Do you want to give them more time?
No. What is the answer?
Okay. 31% said 10,000 and 69% said 5,000.
69% are correct. Almost I can take it as a 70%. But the percentage for 10,000 is very high, because as we can see from the principle, 50% of the cost was allowed as a government grant, mean 20,000. Cost of our asset is 40,000, and we were allowed 20,000 as a government grant. Principle is very simple. That grant will be recognized as income the way you depreciate the asset. How you depreciate the asset? Using straight line method. And in this case, 4 years life and nil residual value. Simply this means first year depreciation will be 40,000 divided by life equal to 10,000. This is the depreciation for the first year. How we calculated this depreciation? Simply cost minus residual value divided by life. The same approach will be applied to calculate the government grant, which will be recognized as income at the end of first year. Mean government grant divided by life, 20,000 divided by 4, 5,000. So 69% are correct. I hope it should be clear. Okay, similarly, another pop-up question for first year only, reducing balance method. For first year only, reducing balance method. Options are A, 10,000, B, 5,000,
Okay.
C, 8,000.
The pop-up has been launched.
So please participate in this very small question. And this time, there should not be any person who has not answered correctly.
Okay, so 23% people.
Okay. So what is the answer?
64% saying 8,000,
Hmm.
24% saying 5,000, 12% saying 10,000.
64% are correct. See, the principle is very simple. Cost of asset is 40,000. How you calculated depreciation using reducing balance? By simply multiplying the 40% with the cost. The same methodology will be applied to the government grant. Government grant is 20,000. If asset is being depreciated using a reducing balance method at the rate of 40%, simply multiply this 40% with the government grant, which is 20,000. When you will multiply 20,000 with 40%, this will give you 8,000. Means simply apply the same formula to the government grant figure. This will give you the grant to be recognized as income during that particular year. So like this, here you can see that first year 5,000. Like here in the straight line method, 40,000 was the cost, nil residual value. This means every year 10,000, 10,000, 10,000. Straight line method, government grant, this means equal amount, simple. Government grant divided by the period of, divided by the life of the asset. So this gives you the 5,000. Here you are calculating these amounts by multiplying the 40% with the cost of that particular asset. And at the end of the year, this is the residual remaining value of the asset, which is taken as a depreciation for that year. Similarly, you can calculate, you can apply the same approach to the government grant of 20,000 to calculate the government grant to be recognized as income in year 1, year 2, simply see here 8,000. Next year 20,000 minus 8,000, mean 12,000, 12,000 into 40%, this will give you the 4,800. Similarly, in third year, 20,000 minus 8,000 minus 4,800 into 40%, this will give you the 2,880. And at the end, in the last year, the balancing amount lying in the government grant account will be charged to the profit and loss account, will be credited to the profit and loss account as income. Same way, the way you calculate the depreciation using the reducing balance method. Assume this is not a government grant, this is an asset and I need to depreciate it. So in fact, that depreciation is in fact the government grant which will be transferred to the income statement. I hope it should be clear. So please answer with yes if you are clear with this concept. It's a very simple concept. I just remind you, but I mean, 64% were correct. Rest of the people were not. The rest of the people did not answer.
Yes.
Okay.
Lots of.
Okay. Thank you. Then the accounting principle number 3. There may be a series of conditions attached to a grant in the nature of a package of financial aid. An entity must take care to identify precisely those conditions which give rise to cost, which in turn determine the periods over which the grant will be earned. When appropriate, the grant may be split and the parts allocated on different bases. This is a very practical point. Earlier, we just learned 1, 2, 3, but now this is something which need to be studied from your practical situation, from the agreement with the government, with the terms of the reference of your grant, which you agreed with the government. From there, you will see this thing. What are the conditions? What are the conditions attached to it? Next is, an entity may receive a grant as compensation for expenses or losses which it has already incurred. Alternatively, a grant may be given to an entity simply to provide immediate financial support where no future related costs are expected. In cases such as these, the grant received should be recognized as income of the period in which it becomes receivable. And next is, a non-monetary asset may be transferred by government to an entity as a grant, for example, a piece of land or the other resources. The fair value of such an asset is usually assessed and is used to account for both the asset and the grant. Alternatively, both may be valued at a nominal amount. And the next principle is, in case of grants for non-depreciable asset, certain obligations may need to be fulfilled, in which case the grant should be recognized as income over the periods in which the cost of meeting the obligation is incurred. For example, if a piece of land is granted on a condition that a building is erected on it, then the grant should be recognized as income over the building's life. Now, let's look at the presentation of the grants related to assets. There are 2 acceptable methods. You can decide yourself or your company. One is set up grant as deferred income. Other is deduct the grant in arriving at the carrying amount of the asset. It depends on the method, and it depends on your policy that will affect the ultimate presentation of your financial statement. Like, we can understand it, or we can refresh it with the help of this example. A company receives a 20% grant towards the cost of a new item of machinery, which cost $100,000. The machinery has an expected life of 4 years and a nil residual value. The expected profits of the company before accounting for depreciation on the new machine or the grant amount to $50,000 per annum in each year of the machinery's life. So let's see what will be the presentation. If we set up the grant as deferred income, so this means in the balance sheet, you will see deferred income under the liabilities. This is the cost of the asset, and this is the depreciation, and this is the accumulated depreciation at the end of first year 25,000, at the end of second year 50,000, at the end of third year 75,000, and then at the end of year 4 0. And the government grant is being transferred to the income statement over this 4-year period. Like in year 1, you can see that 20,000 was the grant in fact, but at the end of year 1, because 5,000 was transferred to the income statement. So the remaining balance is appearing in the balance sheet. Similarly, you will see that in the profit and loss account, you will see that 25,000 depreciation will be there and 5,000 grant will be there. So this is the presentation. This is the presentation of the government grant when it is set up as deferred income. Second is deduct the grant in arriving at the carrying amount of the asset. Here you can see that you will not find the government grant on the face of the balance sheet, because you reduce the cost of that asset, which was 100,000, with government grant. By government grant. Government grant was 20,000 and cost of that asset was 100,000. So what you did, you reduce the value of the asset by the amount of government grant. So you recognize that asset at 80,000. Subsequently, depreciation amount is reduced. And similarly, you can see that in profit and loss account, the net effect is the same. If we just compare it with the earlier slide, you can see that profit is 30,000 in each year. Like here in this case, the net effect is like 75,000, and this is liability. The net effect should be 60,000. Here the net effect should be 40,000. Here the net effect should be 20,000. The same is the case over here. You can see that the net effect is the same, except you reduce the initial amount of the asset by the government grant. So these are the two presentations which can be used.
Shiraz is requesting to repeat this part of presentation.
Okay, Shiraz, if I go back to the example, a company receives a 20% grant towards the cost of a new asset, new item of machinery, which cost 100,000. This means machinery will cost 100,000. And the government grant is equal to 20% of 100,000. This means $20,000 will be the government grant. Now, one method is keep 20,000 separate and 100,000 separate. When you receive government grant and this grant related to this asset, and that asset has a 4-year life, this means this grant will be spread over a period of 4 years. Spread means what will be the initial entry? Initial entry is you receive, we are supposing that you have received this money. For government grant, your entry will be cash or bank debit 20,000, because 20,000 government grant, and credit government grant. Credit means this is your liability. You have received something in advance. Conditions have yet to be met. So you have received 20,000 in advance. Cash or bank debit 20,000, government grant 20,000 credit. Similarly, you bought the asset. Asset debit 100,000, credit cash or bank you have paid 100,000. Now subsequently, what you did, you kept the government grant separate, and every year, if you are using here, you are using straight line method of depreciation. Every year, you calculated the part of the government grant which should be taken as income. Straight line method is being used, and as we learned in our earlier slide, 20,000 will be divided by the life of the asset. So 20,000 divided by 4, so this will give us the 5,000. This means 5,000 out of this 20,000 will be transferred to the income statement. The remaining balance in this government grant will be 15,000, as we can see from here. Here, government grant is separately recognized in the balance sheet. You can see that 15,000 is appearing over here, and 5,000 out of this 20,000 is transferred to the income statement. In total, it is 20,000. And Similarly, each year you are transferring 5,000, based on straight line method, to the income statement, and at the last year, at the end of the life, this government grant is fully transferred to the income statement. So here you can see that in this presentation, you can see that, okay, the user can see that under liabilities, government grant is there, they have received something, government grant, he can see that, and he can see like if it is appropriately disclosed, like profit included the effect of government grant. This is one way of presentation, and we will name it simply like when you keep your assets separate, like you can see that 100,000 is there. We have not affected this figure by the government grant. We kept it separate, we depreciated it separate, we kept the government grant separate. Of course, net effect is the same. The second method is what you do, you see, okay, this government grant relates to this 100,000, 20,000 relates to this 100,000, mean we spended 100,000 and we received from the government 20,000. Okay, fine. We should recognize this asset at 80,000 instead of 100,000. So this will be termed as if you have deducted the grant in arriving at the carrying amount of the asset. In that case, you initially recognized your asset at 80,000, and asset has got life of 4 years with nil residual value. So 80,000 divided by 4, this will give you the depreciation for each year. Now that 5,000 effect is automatically incorporated in this, and when you look at the presentation, you will not find the government grant on the face of the financial statements. You will not find anything. Otherwise, you can see that if I just go back, or if you just recall the earlier slide, you will see that the profit is the same. How it is same? Like profit before depreciation was 50,000. Then in that case, depreciation was 25,000, and then government grant income was 5,000, then net effect was 20,000. But here we are not presenting the government grant separately. We have incorporated it into the cost of the asset. I hope it should be clear. If it is clear, then you can move forward. Okay. Do we have any question then? Otherwise, okay, fine.
Ravi Kumar asking, can financial grants be invested for shorter period, and how it will be accounted for?
See, Ravi, is it Ravi? Ravi, when you receive a government grant, like cash debit, government grant credit, no, what you do with this cash, that is not relevant to International Accounting Standard 20. When you have cash, you can invest, you can buy another asset, you can do whatever you want to do. That is cash, belongs to you people. Of course, there is a liability, but once cash is received against the government grant, liability is recognized, that liability is there, and that liability will be, that is basically deferred income that will be recognized over the life of the asset or whatever. But that cash is there, whatever you want, you can do whatever you want to do. Ravi, I hope it is clear. Once it is initially recognized, both these items are separate.
Muhammad is asking, I presume that deferred income is our asset are receivable on the face of balance sheet if we adopt the first method.
What is the name of this?
Asjad Siddiqui.
Asjad, see, just recall the entry. When you receive like 20,000 from the government, cash will be debit or credit? Of course, cash will be debit. So what about the credit? You are crediting the government grant, something which is credited, that is, in fact, our liability, not asset. It's just like you receive because ultimately you are going to fulfill those conditions. Mean you will be using that asset over a period of 4 years. So that liability will be transferred to your income. It's just like that. If you know that example will take you somewhere else. Okay, Ajit, I hope it should be clear.
Ravi Kumar asking what that income will be called if you earn something by investing the grant.
Ravi, I suppose I could not make you I could not make this point clear. See, Ravi, when you debit cash, like when you issue shares, cash is debit, capital is credit. So capital is there. Now what happened to this cash will not affect your capital. Similarly, once cash is received from the government, that government grant liability is there. What you do with the cash, that has nothing to do with the government grant. That will, if you invest it, that is altogether a separate transaction. Ravi, when you will listen, when you will listen the recording of this session, you will find the answer, because I discussed this point at length just a couple of minutes earlier.
Ajit again asking, kindly give us any example where government provide assistance to the company in terms of operating activities.
In terms of operating activities, like if you follow some environmental regulations, or if your operations are designed in a way, in a particular way recommended by the government may give you a grant for fulfilling those requirements, those operational requirements. Next.
If in special circumstances the government grants in form of write-off the loans taken from banks by some companies of a particular reason, the purpose of the grant is to recover the losses incurred due to natural disaster or other factors. So how to treat this grant? Does it be treated within the scope of IAS 20?
No. Who is this gentleman?
Burhanuddin.
Burhanuddin, no. Because you are receiving loan. If it is at market rate, so there is no benefit. In fact, benefit is there generally speaking, but in fact, this is not a forgivable loan. This is not a loan by the government on which government is charging, or government is requiring the bank to charge a low rate of interest, and the rest of the amount will be paid by the government. So no, answer is
Shiraz Kartik was asking which method is more preferable or I think beneficial, either deducting grant directly from non-current asset, or if we should follow deferred income approach.
No, there is no preference for any of them, which you can see your own individual circumstances where you feel that if you need to disclose this separately, standard as I remember, there's no preference. Next.
What if where you have to fulfill the condition placed by government to receive grant first, and I think the treatment will be as deferred cost in statement of financial position.
Yes, if you receive money and you have not yet fulfilled those conditions, so of course that will again be a deferred income, not cost.
Is deferred income appears under OCI or PNL? Profit and loss.
Profit and loss.
Why standard law to presentations?
By standard laws to presentations, I don't have any specific answer for this. Why they have a lot? But anyway, like if your government grants are significant, so you may find it beneficial for the information of the user of those financial statements, that these should be presented on the face of the financial statement, so that they could see the effect of those transactions on the operations of the company. But if they are insignificant or immaterial or not like very material, so you can deduct it in the determination. But this is something which is my professional opinion, but there is no such thing as you are saying. We can move further.
Yes.
Okay.
I think, sir, the new standard have placed a requirement in respect of varying case to case, where we are having some sort of conditions placed on our grants. I think the standard allows us for these two choices in respect of these conditions as well.
See, standard is in front of me. Presentation of grants related to assets. Okay, we can see what standard says. Standard says government grants related to assets, included non-monetary grants at fair value, shall be presented in the statement of financial position either by setting up the grant as deferred income or by deducting the grant in arriving at the carrying amount of the asset. Okay, what it says in detail: two methods of presentation in financial statement of grants for the appropriate portion of the grants related to assets are regarded as acceptable alternatives. One method recognizes the grant as deferred income, that is recognized in profit or loss on a systematic basis over the useful life of the asset. The other method deducts the grant in calculating the carrying amount of the asset. The grant is recognized in profit or loss over the life of the depreciable asset as a reduced depreciation expense. To this extent, we have discussed like this grant will be credited to the profit and loss account. The purchase of asset and the receipt of related grants can cause major movements in the cash flow of an entity. For this reason, and in order to show the gross investment in asset, such movements are often disclosed as a separate items in the statement of cash flows, regardless of whether or not the grant is deducted from the related asset. So this means there is no such thing as you mentioned here. At the last paragraph, standard is talking about the cash flow statement, that if you feel that normally what people do, because grants related to the assets are normally material and significant, and in order to show the effect of these transactions, the real picture and how it affects your cash flow, you normally disclose these government grants separately in your cash flow statement. Otherwise, there is no such preference so far as the presentation is concerned. In the standard.
Pratyek will asking if the conditions are split over several years, but the entity could not cope with the conditions in subsequent years that are required, what will be the treatment?
Fateh, we are going to answer this question, of course, with the help of an illustration. Let's move forward. Okay. Now is presentation of grants related to income. These grants are a credit in profit or loss, but there is a choice in the method of disclosure. Present as a separate credit or under a general heading, for example, other income, deduct from the related expense. So you have two choices here. Again, you have two choices here. So there are arguments in favor of A, there are arguments in favor of B. For example, supporter of the first method, where grants related to income are presented as part of the profit and loss account, either separately or under a general heading as other income. Supporter of this method, as standard says, claim that it is inappropriate to net income and expense items, and that separation of the grant from the expense facilitates comparison with other expenses not affected by a grant. For the second method, it is argued that, where you deduct from the related expense, it is argued that the expense might well not have been incurred by the entity if the grant had not been available, and presentation of the expense without offsetting the grant may therefore be misleading. Standard says both methods are regarded as acceptable for the presentation of grants related to income. Disclosure of the grant may be necessary for a proper understanding of the financial statement. Disclosure of the effect of the grants on any item of income or expense which is required to be separately disclosed is usually appropriate. Again, here the standard is not preferring any method over other. Standard is leaving this to the management of the company, which method they consider is more important, because any case you will be disclosing this government grant in the notes to the account. So any method can be adopted. If you agree with the argument put forward by the people proponent of the first approach, you can go for the first approach. If you are convinced with the argument put forward by the people who are deducting the government grant from the related expense, you can go for the second approach. Okay. Repayment of government grant. Here, before going for the repayment, okay, let's discuss this. Then I have for you people two small case studies to solve. I think we have sent that handout to ACCA members.
Handouts have been shared.
Okay.
Webinar.
Can they download it?
Yes.
Please, by the time we discuss this slide, download your handout related named practice IAS 20. I have two small case studies over there, which will wrap up the whole concept to greater extent, so that we could have an idea with the help of what we discussed under IAS 20 with the help of those illustrations. See, in case of repayment, very simple. If it is related to the income, if there is an unamortized deferred income, then repayment should be made from that account. If repayment is higher than the balance lying in the unamortized deferred income account, then you will be charging it to the profit and loss account. Related to the asset. See, related to the asset, there will be two treatment. No, the treatment will depend on if government grant is being presented separately, or you have reduced the carrying value of the asset by the amount of the government grant at the time of initial recognition. Okay, let's first of all discuss, then I suppose people may be requesting for Maghrib prayer, so then we can have after the discussion of this slide, we can have a few minutes Maghrib prayer break. So in case of like a repayment of grant related to an asset, increase the carrying amount of the asset or reduce the deferred income balance by the amount repaid. The cumulative additional depreciation that would have been recognized to date in the absence of the grant should be immediately recognized as an expense. Okay, they have made two treatment, like they merged two different treatment into one. Like simply, if there is a deferred income account, fine, and there is a balance in that account, simply reduce that balance by the amount of repayment. But if repayment is higher than the amount lying in that account, the remaining amount will be charged to the profit and loss account, and you will increase the accumulated depreciation. You will increase the depreciation and charge it to the profit and loss account. So next is, we have discussed the government system. Okay, let's have a break. Then we have one small slide. Then we can go for disclosures, and then we shall be discussing illustrations. Please mute it. Okay, welcome back. Uh, here is a list of government assistance. That is, those are excluded from the definition of the government grant. Number one is, this is sort of repetition, though we have discussed some of the concept under the scope and at the start of International Conference 20. Some form of government assistance cannot reasonably have a value placed upon them. For example, free technical or marketing advice, provision of guarantee. Similarly, there are transactions with government which cannot be distinguished from the entity's normal trading transaction. We discussed it earlier. For example, government procurement policy resulting in a portion of the entity's sale. Any segregation would be arbitrary. Disclosure of such assistance may be necessary. Now we are talking about disclosure. May be necessary because of its significance, its nature, extent, and duration should be disclosed. Loans at low or zero interest rate are a form of government assistance, but the imputation of interest does not fully quantify the benefit received. Then, list of disclosure. Disclosures are in fact number one is accounting policy adopted, including method of presentation. Second, nature and extent of government grants recognized and other forms of assistance received. Unfulfilled condition and other contingencies attached to recognized government assistance. So these are the disclosures. I'll keep on trying that I should add the disclosure to my material, but where I feel that they are unnecessarily long. So I may not be including those disclosures in my slides. So if you are really interested in that, you will be having those disclosure list available with you people. The important thing is you may have some questions. You may need some clarification about any of those long listed disclosures. Please feel free to email me. Now let's move to the illustration which I have selected for you people. I hope you people can see this illustration. It is in front of you. You can download it as well. ICL operates. ICL operates. Let me open it in front of me as well. ICL operates. Okay. ICL operates a factory in an underdeveloped rural area. Most of the employees in the factory have been hired locally. On observing the positive effects of the project, the government had approved a grant of 100 million for ICL on February 1st, 2009 for the development of a similar factory in another underdeveloped area. However, it had been agreed that the disbursement would be made in 3 phases. The relevant details are as follows. You people have downloaded this practice question 1 because when I move this page, a part of the question will not appear on your screen. Can you please answer yes if you have downloaded this small practice question? It is better open It has been agreed. What happened? I'm not reaching.
It is okay. The connection was.
No, can people hear me? Okay, I was not reaching you people. In fact, due to some technical problem. Anyway,
Has been re-established.
okay, no, it is resolved. Just I asked you people that have you downloaded these two small practice questions, or can you download it? If it is, do it, because these two practice questions should be in front of you before commenting on the treatment. Okay, thank you. A lot of people are saying they can download it and they have downloaded it. So please go through the practice question one and then answer based on our discussion about the likely treatment of this 10 million, 40 million, and 50 million. Okay. Okay. About the practice question one. See, according to, I hope you people have made up your mind about the likely treatment of this 10, 40, and 50 million. So, okay, let's start discussion on this. See, according to International Accounting Standard 20, government grants are to be recognized as income over the periods necessary to match them with the related cost, which they are intended to compensate on a systematic basis. See, rupees 10 million related to the first phase was received prior to the year end and should be recognized as a liability in the statement of financial position as on June 30th, 2009, because the cost of the asset which the grant is intended to compensate have not been completed or brought into use. Similarly, if the amount of 40 million, the next 40 million, I'm talking about now this 40 million, related to the second phase is received before the completion of the construction of the factory, it would also be recorded as a liability. The grant related to the first two phases, mean 10 million rupees and 40 million rupees, can be classified as grant related to asset as a liability. Once the construction of the factory is completed, government grant related to both phases should be recognized as income over the period of the factory's depreciable life, that is 15 years. So this is the treatment of 40 and 50 million. No, for the remaining amount, the amount of the grant to be received in the third phase would be recorded as income when there is a reasonable assurance that the company will comply with the condition employment of 400 locals, the grant will be received. If these two conditions are there, like here is a condition of like they will have to employ 400 local persons. Once this condition is met, that amount can be recognized. Okay, now come to the second small scenario. At the beginning of 1997, Mehran Limited received a grant of rupees 5 million towards the cost of establishing a plant on the Thatta district for a minimum period of 5 years. The sanction letter states that if the company ceases to use the plant in the Thatta district, it is required to repay the grant less rupees 1 million for each completed year of use. The cost of the plant before the deduction of the grant was rupees 15 million and the plant has a useful life of 15 years. The company uses the straight line method of depreciation at the beginning of 2000, mean after 3 years. 2000 is the 4th year, but at the beginning of 2000. Following a reorganization of its operations, the company moved the plant to Karachi. Required. How would be the amount refunded be treated in 2000 accounts if the grant received was treated as a deferred income or as a reduction in arriving at the carrying amount of the asset? Okay, please do your calculations. Very small calculation. See, 5 million is government grant. 15 million is the cost of the plant. Life of the plant is 15 years. Because they have moved this plant, so they will have to repay this government grant. How much? See, it is written over here, like they will have to repay. If they have completed 1 year, they can retain 1 million. So here in this case, they have completed 3 years. At the start of 4th year, they transferred their plant. So 5 million minus 3 year into 1 million mean they can retain 3 million, but 2 million will have to be repaid. This is the repayment amount. Now, if you have treated this government grant separately, then at the start of 2000, 2 million rupees will be lying there. So what you can do that you can credit or debit cash and debit this deferred income account. So this will be the entry for repayment in case government grant is being separately treated. But if you have deducted the government grant from the cost of the plant, meaning you recognize the plant initially at 10 million, mean 15 million minus 5 million, then of course you are returning 2 million in fact. So the treatment will be, you will be adding this 2 million to the cost of the plant, and you will be immediately recognizing the depreciation related to this 2 million over a period of 3 years. So this is the treatment of, like in case of repayment and treatment of the depreciation. If you people have any question, or we can go for a feedback. Can we run a feedback at this point in time?
We have a poll.
Yes.
We have a poll of feedback.
Please, if you have any question related to this practice question 1 and 2, you can ask it now. By the time you can make your question, we are running a feedback pop-up. Okay. Okay.
So far, 24% have participated. Lots of people are saying in chat, thank you, but I think I must recommend them to interact with the poll and to give feedback over there. So for 30% people only.
Can you please announce the result of poll?
Okay, we are having 32% people say excellent, and 55% people saying very useful, and 12% saying good.
Thank you very much for your encouraging feedback. If you want to repeat this session, you can listen to the recording. That recording, the link of that recording will be sent to you people by the ACCA team. Thank you very much. Bye from my side.